The start of the year has not been great for the markets. In the first 20 days of January, all broader indices are in red. The Nifty 50 and Nifty Midcap 150 are down 2%, and the Smallcap index is down 4%. In fact, most of 2025, the markets were range-bound. Large caps were slightly better off because they recovered from the correction that we saw towards the end of 2024. However, the performance of mid and small caps was dismal. Now that markets have been taking a breather for over a year, have valuations become attractive? Let's find out in this video. Now, if you've been following our channel, you probably know that we regularly assess market valuations. We last did this exercise in July 2025. At that time, the markets had recovered from their September 2024 correction. After the recovery, it felt as if markets wanted to sit back and take it easy for a while. So nothing much has happened since then. The markets have been undergoing a time correction. Alright, so let's discuss where we are today. Are the markets overvalued or are they now trading at a discount? Which segment of the market now has the best valuations? Hello and welcome to ET Money's YouTube channel. We will use 5 measures to assess market valuations. After watching this video, you will have a thorough understanding of current market valuations from multiple perspectives. So do watch this video until the end. Now this video belongs to our playlist on market trends. If you'd like to watch similar videos, you can explore them. The link is in the description. Alright, let's start with the first valuation metric. A natural question that might have come to you is, why haven't we picked the price to earnings ratio? Well, the PE ratio depends on earnings, which can be volatile. In good economic times, earnings can explode, and in bad times, they can sink. That can distort the valuation picture. Secondly, earnings can be influenced by non-operating factors, so they don't always act as a proxy for business growth. In our quarterly result update videos, we have frequently seen cases where the profits are higher, but the operating margins have slipped. In other words, the growth in profits was not due to business performance, but due to other factors such as other income, one-off gains, a fall in depreciation or interest, or tax, etc. And that's why we decided not to use the PE ratio in its classic form, but we will still use a modified variant of the PE ratio. More on it later in this video. Now, if you'd like to know more about the pitfalls of the PE ratio and what alternative valuation metrics you should use, you can check out our video on this topic. The link is in the description. Alright, with this, let's begin with the price to book or PB ratio. The PB ratio is calculated by dividing the stock price by book value per share. At the index level, it's calculated by dividing the total market cap of the index by the total book value of the index constituents. Let's check the current PB of various market cap segments vis-a-vis their historical medians across multiple time horizons. All 3 market cap segments are currently expensive in historical terms and across various time frames, as indicated by their premiums to the median values. The midcap segment, as represented by the BSE 150 midcap index, is especially overheated with its premium to median ranging from 26% to 78% across time frames. Even in July 2025, midcap caps weren't cheap. At that time, the premium to the median PB ranged from 27% to 57%. Now, similar observation can be made for small caps too, with its premium to median ranging from 16% to 65% across time frames. However, the premium difference has slightly reduced from the July levels. Finally, at a premium of 12 to 38%, the large cap segment is the least expensive of all market caps. Alright, let's now check the valuation of these 3 segments in terms of their dividend yield now. But before that, here is something relevant to the growth of your portfolio. Many of you come here for the kind of mutual fund analysis you rarely find elsewhere. Rolling returns, downside protection, and so on. But knowing how a fund behaves is one thing. Figuring out how to use that information in your investing decisions can be difficult because each of us have our own risk, comfort, and goals. That's exactly why we built ET Money Select. It's a personalized shortlist of funds that stand out from 2,000 plus mutual funds, not just on returns, but on how consistently they deliver and how well they protect when markets fall. The list is personalized to your risk appetite and gives you funds for long, medium, and short-term horizons. And for every fund, you get a simple note explaining how it invests and what drives its performance. Plus an alert if the fund starts to dip or a better alternative is found. So do check it out. The dividend yield is calculated by dividing the dividend per share by the stock price. At the index level, it's the weighted average of dividend yields of individual stocks comprising the index. Now, if the current dividend yield is below the historical median, that indicates an overvalued market. Yes, overvalued and not undervalued, because it implies that you are getting less in dividends, possibly owing to elevated market levels. Similarly, if the dividend yield is above the historical median, that indicates an undervalued market. So let's take a look at the current dividend yields of the three BSE indices that we just saw. Now, as far as large caps are concerned, as represented by the BSE 100, the current dividend yield ranges from the discount of 0.8% to 5.6% of the median values. For mid caps, the discount ranges from 7.4% to 13.8%. This suggests that they are expensive too. A similar trend is observed for small caps, with the current discount ranging from 12.7% to 26.6%. Overall, in terms of dividend yield, small caps are quite expensive, large caps are reasonably valued, and mid caps lie in the middle. Okay, let's now move to the next valuation metric. As I mentioned briefly, we are using a modified variant of the PE ratio. That modified variant is the Cyclically Adjusted PE ratio, or the CAPE ratio. Let me first explain what it is. Now, as we discussed a short while ago, the classic PE ratio uses earnings which can be volatile due to business and sectoral cycles. The CAPE ratio addresses this volatility in earnings by averaging the inflation-adjusted earnings over a 10-year period. This helps smooth out short-term fluctuations and get a more accurate picture of valuations. The CAPE ratio is also called the Shiller PE ratio, as it was introduced by Professor Robert Shiller in 1988. Now, Joshi Jacob and Rajan Raju of IIM Ahmedabad have calculated the CAPE ratio of Nifty 500 based on 5, 7 and 10-year business cycles. Let's take a look at where the Nifty 500's CAPE stands with respect to its median. With respect to the 10-year business cycle, the CAPE is currently at a premium of 55% to the median of 26.7. This signals an overvalued market. In July 2025, this premium was 57%. So in a way, it has not changed much. As far as the 7-year business cycle is concerned, the CAPE is at a premium of 43% to the median of 26.3. Here also, it's almost similar to the July 2025 levels. Finally, if we check the CAPE for the 5-year business cycle, the current CAPE is at a premium of 32.5% to the median of 25.2. In July, it was 36%. So it has slightly reduced on a 5-year level. Thus, across all CAPE time horizons, the Nifty 500 is more expensive than the median. Okay, now let's talk about the next valuation metric, market cap to GDP. But before that, do subscribe to this channel if you aren't already a subscriber. And don't forget to press the bell icon so you never miss a video from us. The market cap to GDP ratio is also called the Buffett indicator, as Warren Buffett personally likes this valuation measure. It is derived by dividing the market cap of all listed companies by the country's GDP. When the market cap of all listed companies is more than the GDP, the market is said to be overvalued and vice versa. Now, the total market cap of all listed companies in India on the BSE currently stands at about 472 lakh crores. India's GDP is approximately 345 lakh crores. So this gives us a current market cap to GDP ratio of 137%, which means that the market cap of all listed companies exceeds the country's GDP. That suggests overvaluation. But it's also sensible to assess the valuations vis-a-vis the historic median. The median value stands at 112%, so the current value of 137% is at a premium to it. So both absolutely and in relative terms, the market appears to be overvalued in terms of its market capitalization to GDP ratio. In July 2025, the market cap to GDP was around 139%, so it has not changed much. Alright, let's move to the last metric, the bond equity earnings ratio, also known as the BEAR ratio. To calculate the BEAR ratio, the yield or the expected returns from a bond is divided by the market's earnings yield. The earnings yield is nothing but the inverse of the PE ratio. Put simply, if the market were a bond, the earnings yield tells you what returns you would make from it. So comparing the bond yield with the market's earnings yields can tell you about their relative attractiveness. Theoretically speaking, if the BI ratio is more than 1, that suggests the bonds or fixed income are more attractive now. And if the BI ratio is less than 1, that suggests stocks are more attractive now. However, in real life, that's seldom the case. In the case of Indian markets, the BI ratio has seldom fallen below 1. That's why it's more practical to check the deviation of the BI ratio from its historical median. So if the BI ratio is above the median, that indicates an overvalued market and vice versa. Now, as a proxy for the market, we have considered the BSE 500. For bond yields, we have used the 10-year GSEC yield. Now, as against the 10-year median of 1.77, the current BI ratio stands at 1.68. That's a discount of about 8.5%. So, as per this measure, the market is currently at a discount to its historic valuations. Alright, with this, let's summarize the results from the 5 indicators in the concluding section of this video so you can get a comprehensive picture of market valuations. In this video, we assessed market valuations across 5 valuation metrics: PB, dividend yield, CAPE, market cap to GDP, and the BI ratio. The summary of this analysis is on your screen. Now, in all cases except for the BI ratio, the markets are currently overvalued. So what can you expect here? It's not possible to predict or forecast. However, markets mostly follow valuations, so it may need a trigger that indicates valuations turning attractive. Now, what can that be a trigger? It's the growth in profits of corporate India. Soon companies will report their third quarter results. If the results are encouraging, we may see positive momentum. Otherwise, markets could remain range-bound. Now, most experts are expecting earnings to pick up from mid of 2026. That means the second quarter of FY27. Now, we also cover corporate earnings in our videos every quarter. So watch this space. You can check our previous videos. The link is in the description. And one more caveat here. While it's good to check historical valuations, market movements are more of a function of future expectations rather than past valuation multiples. So do take into account growth expectations too. So what should be your investment approach amid the current market conditions? Asset allocation is the ultimate solution to dealing with any market conditions. Within asset allocation, dynamic asset allocation can actually help you not just survive, but thrive in any market phase. And that's all I had for you today. I hope you found this video useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.